let's get started here. Just a quick agenda page, what to expect. This is the second day. We streamlined things into 2 days. Yesterday we talked about data feeds. We talked about some chart templates to get you started. And then we covered a little bit about what I feel is important with market profile. I'm not a big, I'm a proponent of market profile, and people could use it as deep as they want. I do like it as one of the tools I use. And then we talked about the footprint, which I want to go into a little deeper today, and using it specifically on how to trade. So we'll talk about balances and imbalances that are often showed by the footprint. I'll show you a preview, and if you guys got your software open, add the big lot filter option at the bottom, which I'll be able to walk you through. You guys ask questions throughout the session and at the end, and then I'll talk about some incentives to subscribe when your Market Delta trial is over. So let's get started. What's useful and what's not? And I touched on this yesterday about not to get confused and overwhelmed with too much up and down the price ladder or inside this footprint, just in important areas. Now, I have areas, a couple of you guys that were in the trading room today, seeing the gray areas that I call alert levels that I put out every night to people before the trading session, that I use as usually 4 tick areas in the ES and 2 tick areas in the bonds and 6 in the NASDAQ and so on and so forth. But point is that it doesn't really matter. I mean, there are better areas of support resistance than others, but it's like that's where you begin to start to look for what you're waiting to look for. Like I said before, you'll never find what you're not looking for, and if you're constantly burning your eyes out at every single uptick and downtick, you're going to miss too much. And so where's the game going to be played, and then what are you looking for when you see it? Now, in this particular picture, what's useful is as the market walks up into a zone, so it walks up in here, retraces lower, re-rallies to the edge of the zone, retraces lower. This second push into the zone is met with an imbalance right in here, a slight imbalance, but also an influx of volume. And keeping the theme in a word, simple. I'm looking for this market to rotate away from this alert level. So this alert level is essentially resistance. Comes in and I start to see an influx of volume. I'm not looking for it down here. I'm not looking for it here or here or here. If I'm looking to get short or cover along, but in this case get short, this is what I want to start seeing to identify whatever price this is to take a shot and get short. So if you look at, I often talk about ready, aim, fire. The alert level is getting you ready. The aim is when you start to see maybe a big buyer who can't get the market to rally. And then fire is also the volume picking up in your zone. So it's like that progression where you're looking for something, you find it, and now you know where to get in. So like I think I said yesterday, it's almost like if the monitor had a hand that came out of it, it would come out and said, hey, look, you got an alert level where you think the market's going to stop going up and then rotate down. You got big volume. So if your monitor had a hand that could come out of it, it would slap you and say, get short or cover your long. Either way, the downside is most likely the next right side of the market. So again, real simple stuff, and the footprint shows you all of this accumulation real time, right? Better than just a straight market profile chart will, or any other just basic candlestick chart or things like that. So that's what's useful, are the surges in volume. And now we had an example back on the 2nd of January, but since we're further on through the month, I'm going to pull up some other examples on my real-time chart in a second. But why does markets rotate and move? And I touched on this in the trading room today, and a couple of you guys were in it. But it's about not where people are getting long and opening a long position. It's about where people are buying it to cover a short position. Whether it's a short position because they're wrong, taking heat underwater, and they got to buy it to puke and cover that short position for a loss, or if they're short from up here and the market went all the way down here, but they didn't get out, and it's starting to creep back to where they entered. And I said this in the room today, getting short here, not covering at or near the low and seeing this look like a, even if it's a big 20-tick winner from this circle down to this line, if the market starts creeping up and now it's only a 15, 10-tick winner, you don't feel like you still made 10 ticks. You feel like you lost 10 because it went from a plus 20 to a plus 10. You're starting to feel the same emotion, similar emotion as a guy who sold it bad down here and now he's taking heat as it's starting to walk away from him. Either way, markets rally on shorts covering and they break on longs that cover for the most part, right? And so when you start looking at it through that prism, you lay logic that creates, well, would make sense that if I'm ever going to create a consistent successful trading plan, it has to circle around the logic of what makes me special, where I could buy it and have people come in after me buying at a worse or higher price. Well, that's because they're emotional and they're puking a short position that they're either wrong in, losing money, or seeing profits diminish. Either way, they're emotional. That's what gets people to pay a higher price. And so that's a logic that is involved in any product, whether it's a future, a stock, an option, a car, a boat, anything. If it's got price attached to it, it has those elements of emotion that drive it up or down. So you got to look at yourself as a negotiator and what's the best read you could get on the person you're negotiating with. The footprint is that, seeing guys stuck in an area on a rally to be able to fade a move higher, fade a move lower. Contrarian trading it's not the most popular trading strategy among everyone that I know who's successful. It is the strategy of everyone I know who's most successful. And contrarian, real quickly, is just a market rallies and you're looking to sell it the whole time. Market breaks, you're looking for a place to buy it and get long. Even if you're a trend trader, you're looking to buy a pullback on a trend. Here's the pullback, right? It's trying to buy these rotations lower for these highs to get taken out. And you're looking for the market to re-rally. So you're in a sense a contrarian because you're buying against the grain in that pullback or retracement. So again, it's not the most popular. It is the strategy of every successful guy I know growing up in the business from the floor, from the prop firm environment and such. So let me walk into, before we go into this preview, let me walk into the chart that I show in the room, and I'm going to blow up the ES. This is the S&Ps, and this is actually live. Today's market action is trading 87 quarter, right back up to where we opened. I could review the day and talk about certain things, but really I'm trying to get people to understand the footprint. Now, guys that are in the room, I missed this, and I walked through why I missed it. My worst trades are missed trades. They're not losers. My best trades are small losers. My worst trades are missed trades. And I missed a couple today, and one of them was up in here as the market ran up into an alert zone that you've seen on that previous picture between 89 even and 90 even. It was just a predetermined level. Some people also had it for different reasons that I had it. Either way, it worked, and it showed if you just focus in on inside that pink circle. We had an influx of volume starting to come out at 87 or 89 even, and an imbalance that came out right above that at 89 quarter started to show it started to show it was an imbalance when it was like 700 by 2000 and slowly accumulated to become a pretty nice imbalance. Now, I don't know, and neither do you, that the market's going to look like this and go straight down at any one point. So we're trading it. It looks like that. We don't know if it's going to continue up. That's the whole notion, though, is a ready, aim, fire type of approach where you think it's resistance, you're able to see an imbalance, and now you're looking for the market to go lower. Now, using the footprint to trade is going off of yesterday. You've got aggressive buyers at this 4,362, and you got passive sellers. People are lifting the offer which at the time is 89.25, right? So if you take this price level over to here, it's 89.25. And if it's on the right side of the profile or the footprint, if I were to split the footprint in two, that's 89.25 when it's offered. That's what trades on 89.25 when it's bid. Either way, aggressive buyers are trying to get this market to head higher and attack the overnight session highs. Yet, someone's in here accumulating a lot of those aggressive buyers. And again, is it going to say this market's over with and it's going to go lower and it's going to look like this? Of course not. But it's giving you that ready, aim, fire dynamic that's starting to play out. And it's creating a trading plan where now what makes you so special to think you could sell it here and get people to come in after you selling at a lower price? That's going to make this trade profitable. Well, what's going to get people to do that is they're either stuck long looking for higher highs above, and they're getting trapped in here, and they're emotional because they're long and wrong if it starts moving against them. And the people who bought it at better prices in here after the open or during the open, if the market starts to walk back down to their price, they're feeling emotional because they want to cover that long to take any kind of profits. The worst feeling anybody has had, and anybody who's traded for 5 years or 5 minutes knows this, is to have a nice winning trade turn into a nice losing trade. You should not have that happen. That should not be consistent inside your trading strategy. A nice winner turn into a nice loser is an awful feeling. A nice winner turning into a scratch is a bad feeling. So that's what people are feeling that you're trading against that are long in this zone in here. So for the market to come off, you're looking at playing out the logic of trap longs at the top. And as soon as you start walking away, this is a much longer bar down than I could have imagined. And if I did sell it up there, which I thought of and I was gonna, but I didn't, I would not have taken the whole move out. I would have scaled out here and here and here on the way down, probably taking a +8 on the final scale, whatever that would have brought me down to, probably here, and missed this, but I would have been okay with it because you'll never go broke taking profits. That's where that phrase comes into play. But either way, this market had a long rubber band that stretched down to 84.5. It's still a low, and it started to walk up, tried to re-break and make lower lows, and then once it couldn't, it was kind of just a slow tempo walk up through this bar, and anybody now who sold it down here started to have to buy it right back to the open, so on and so forth. And now the market pretty much came around and has done what I thought it was going to do, other than whether or not I attached a trade to it, just chop around this high volume node that came out right here at 86 even. It looked like it took some buy stops out, and it's now just choppy in between today's open and POC and this other high volume area that came out in just one instance that threw out a lot of volume at that price without moving from it. Finally, it got away from it, came back to it as a magnet, and it's chopped around to it. So really, the two lines in the sand is pretty much the open in these 86 quarters, which they're trying to press back down to. So again, without trying to go into too much analysis, just looking at where you want to make a trade, where you want to get ready to trade, and then what are you looking for? And you're looking for just a surge in volume, and then tacking on some aggressive buyers or sellers and what the market does. So this is the second part of how to read the footprint to trade. Down below, right here, is the filtered element of what's above. So every trade that takes place is going to be documented inside this footprint above. This lower half down here is filtered for, I have it for 189 contracts or more. So if there's one splash of 189 contracts that come in at the same time, whether it's one order, bunch of little orders that get pushed out on the time and sales as a big order, it's going to show up on this bottom filter. I have it set, and if you right click, if you have your software open, I'm going to add this. How many people got their software open? All right, good. So if you want to add this, go into the top portion of your market or of your chart. You two guys want to add it? The guys that said their software is open? So you right click into the top portion of it, which would be the only portion of it if you don't have it. And you're going to want to add, delete, edit, and you want to add instrument. Okay? So left click, add instrument, and it's going to bring up this window. You're going to want to uncheck align with master. You're going to want to go to footprint data tab, which will bring up this. Check volume filter and put for whatever size you want in there. The less liquidity in a market, the less would be considered big size, like the Russell or the Dow or the NASDAQ would have a different filter than the S&P should. Notes, bonds, and everything else is all relative. I go with 189, and actually that might have been too small today, as you could see all the cluster of activity underneath in the footprint. I'm not going to add, but just hit OK to add it. I'm not going to add it because I already have it. But you could change oh, there was one other thing. When you go in here, add, delete, edit, add instrument, you want to double click the instrument you want to add, which would be the ES pound or whatever it is that you're going to add, and then change those settings. Uncheck align with master and check the volume filter. Those are in, and that's a good question, Vince. I have it on other charts and not on this one. How do you add the rolling totals, which is called the footprint bar statistics? So right click. You're going to want to add a technical indicator, okay? And you're going to be pulled up this list, okay, Vince? Scroll it all the way down to, when it's alphabetized, to footprint bar statistics, which is right here, okay? It's going to pull up this window, Vince, and it's going to give you what you want in that information. Total volume, total delta, and then the total delta for the whole day accumulated. So let's just go with these three. Let's add and close it, and then you could see at the bottom it's added it, right? Let's open this up so we could, oops. I got the chart at the bottom. Let me open it up like this. So each bar has got statistics in it, which is shown now at the bottom. So for instance, this bar here, the stats in it would be corresponding below. So total volume in that bar was 10,829. The difference in delta was 34.99, and for the day, the running total at that point was 22,366, and you could see how it's flowed throughout the session. So, and there's other elements you could add to that. So if you were to right-click it and go to Edit Preferences, and it's real simple to add from this whole list other items you'd want to see and play with it a little bit at a time. The most helpful the delta is. All the delta is for you guys is it's subtracting the buyers and sellers, right? So if there's more aggressive, right down in here, the total volume 16.99. That's all the volume that's traded in that particular bar. So the total delta is subtracting the aggressive players. So there's been 2,704 more aggressive sellers than buyers. That's just what the delta is. If the deeper red it is, the more aggressive selling there's been, or people hitting the bid. The deeper blue it is, the more aggressive buyers there have been, or people lifting the offer, like I spoke about yesterday. Now, keep it simple, because it's logic that has to prevail when you trade. Don't think too much or too deep. Just use it for what it's worth. Generally, the bigger the delta day is negative, the lower the price is. So if the delta day was minus 100,000, which would be a big number, the S&Ps would probably be down 20 points on the day. So it's important to realize that aggressive sellers and buyers do and should dictate price. So if the delta day is a big down number, but price isn't, what's that telling you? That the market might have some underlying strength here, and it might be set to pop. People are getting stuck short. Price isn't going like it should. That's what's important in understanding a market, is starting to identify where guys are stuck. Does that make sense? Hopefully that logic is important. I've been trading for 12 years. Nobody would dismiss the element of stuck traders moving prices for profitable traders. Your job as a trader / detective is to find where others are long and wrong, short and wrong. Now, any trader that I know is successful would always incorporate a market relationship with understanding the third concept that I convey, and that is trying to find where guys are stuck. Every guy that I know uses those concepts. So let me read some of your guys' questions as I go through this. Vince, were you able to throw that in on your chart? Perfect. Sam, hold on one second. So let's move on to the big lot filter. Let me get rid of this just for the sake of cleaning it up. So now at the top again, we've got everything that's happened in transaction on a bid and offer throughout the entire session, and it's filtered down below. So let's change this filter from 189 and let's look at it for, let's say, 249. So anything greater than 250 and above will now be refiltered in here, and you can still see it's busy. So let's just go and look at going to even something higher like 350 or 349 and above, and going and seeing a little less activity. But again, what I'm trying to look for is where guys might be buying it and it's not going up, selling it and it's not going down. Now you sell 600 in here. It could be a couple 300 lot of orders, but there's some good aggressive selling, and the market does kind of go lower. But when it comes back up to that guy, if they can't defend that price, the upside is probable. Then he comes in and buys a ton, and he gets the market to go bid, and there was another big buyer, less than 300, that came in, and it helped just slowly but surely keep the market from coming back down and rotated all the way back up to the open at that particular time. So the market comes back down, right? If you're just looking at the bottom footprint, the market comes back down to where? To where this big buying came in and this big selling came in. Is that a coincidence? I mean, there's other reasons why it might have came down there and you guys might use and everything else, but it's always a magnet where you get big volume to come out, but then also where the aggressive buyers and sellers came are also areas of potential support for a market. It came back down here once in here and twice in here, and it's held as the bottom and kind of a floor of the market since it made those 84 half lows today. So to me is when people say, well, what do you want to see in your area? Do you want to see big sellers come in a resistance area? And the answer is, yeah, that's fine, but it better go lower if a big seller is aggressive and he sells it. If not, I'm nervous. I'd rather see a big buyer come in resistance and the market can't go bid. That's order flow. That's it. You know, order flow is a phrase that's thrown around in trading, and not too many people understand it, and furthermore, not too many people educate accurately on it. Order flow isn't only recognizing buyers and sellers. It's what the hell the market does after you recognize buyers and sellers. A big order comes in buying the offer, and the market can't even budge higher. It's like what I said yesterday. It's like punching a guy in the face with all you got and he doesn't flinch. That's what you want to see. Are there other guys that seen that buyer, got long with them, and it won't go, and they're stuck long? Now they're sellers, and the market has an easier chance to go lower. Again, you'll never be able to kind of incorporate that into a trading plan maybe you already have, or one that you're trying to create, unless you know what you're looking for. That's order flow. It's difficult to see it because things are moving with much higher frequency on a dome or a price ladder. So you need the footprint and a filter to be able to kind of recognize and have a nice point of reference to see back, hey, where did those guys come in? And you're able to see it on the footprint a lot easier than if it was just a candle, because candlesticks only show you very limited information. So in a nutshell, that's how you use the footprint to trade. I mean, I could go on, and I have webinars, and I talk about this in real time and execute around it in the trading room. So if you want, you could come in and join the trading room to give you a better sense of how to use the footprint, the profile, and other market delta software, or other elements of the market delta software and the charting and whatnot. I also do webinars that go into detail about how to use the alert levels and more examples of recognizing big buyers in the market can't go up, or big sellers in the market can't go down. But I mean, that's the best way to use the footprint. The best way to use a profile is not just to analyze what's going on in the market you're trading from a profile sense, but analyze ancillary markets that are also, that you're also analyzing what the profile is telling you in those markets. Now, I don't do that profile to profile, but I've told that to people for a long time now, is don't just concentrate on one market. There's not one successful, profitable trader that I know, and I know a lot of them, that only look and watch one market. They have one monitor that has 7 or 8 markets or domes up, just price ladders up, and then a few other or a couple other windows or monitors that have, several charts, and they know what the Euro's doing, what the Russell's doing, what the S&P's doing, what crude oil's doing, what other correlated markets are doing. I'm a big stock index versus treasury guy, where bonds go down, stocks go up, and it helps me understand value. Now, we had a little bit of that today in the comparing the NASDAQ to the S&Ps. The S&P was the weakest index out there. It had to go up in order to go down, but it still couldn't make higher highs. So when we started getting these yellow arrows, and it wasn't even close, and these yellow arrows are saying, hey, the NASDAQ's making highs. And I look at other markets, but the thing is that you had this market drive into a resistance zone, you had shorts get shook out, and you had an indication that the S&Ps should be a lot higher. Where can I sell it? You see an imbalance in resistance. 4 reasons for the market to come off. Again, I got to disclose, I didn't sell it. I wanted to, thought about it, missed it, and then down it went. Point I'm trying to make is that is got to be incorporated in any plan that you create, is watching markets that help influence your markets in order to pull value out of it, and then look inside the charts or inside the footprint to find where this activity might be getting long stuck and whatnot. And so that's kind of what's important. That's kind of what's important when you trade anything, when you buy anything. So what I'll leave you guys with is, maybe I said this yesterday, and if I did, I'm repeating it, and there's nothing wrong with repeating what's important. And what's important is, everybody, whatever you use to find value in buying a car, a house, or a plane, use it to find value in trading. You guys got questions, pop them in, and then I'll walk people through it, and then go over a couple other things and wind things down for today. Here's a question. Can you have both the bonds and the ES on the same chart, top and bottom, showing both? Yes, Sam, you can. Could you email me Reply to that email, Sam, and I'll walk you through how to do that. But reply to that email. I sent you the 2 links. Yeah, just reply to the same one that I sent you yesterday with the 2 links in there. I streamlined the 3-day event. There's not going to be a webinar tomorrow. It's going to be canceled. I rolled everything into 2. We were doing 3s. 2s are better and more efficient. However, you guys are still in trial. You'll be invited to come back to next Tuesday and Wednesday and talk a lot of the same stuff. It's generally the same information, but I'm kind of walking people through real time that day market, if anything's set up, what's set up, and see the consistency from one to the next. So you guys will be invited to come back next Tuesday and Wednesday to this 2-part educational series. Let me go back to the PowerPoint a second. And this is what I took a snapshot and talked a little bit just from a picture sense of, if this is the gray area zone that I had as resistance and the market walked into it once, twice, what did it look like that 3rd time? Remember that volume that came out I showed you on the previous picture? You had a big seller, and what was the reaction after the big seller came in? Did they hit the bid and take it offer right away? And if they do, that's where I want to say, hey, maybe there's a shot to get short. And the market walked 6 ticks pretty effortlessly lower, as this did signal a little bit of a resistance and whatnot. And again, it's big sellers, but the market doing what it should do when you see that. Now, why to subscribe? Some of you guys got a little time on your trial, some don't. Depending on where you're at, we do live premium webinars that aren't these 2-day events to subscribers and Market Delta chart users only. You'll be invited to that. It's not just about content, how to use the footprint, but what ancillaries are really working well, correlated markets that are working well at that particular junction of trading in the month, and some other cool things that subscribers get invited to. So you'll get access to that when you guys sign up. Call, though, Market Delta sales at marketdelta.com if you want to email. Here's the phone number if you got any sales questions. You'll be taken care of. Here's the support at marketdelta.com for any technical questions that they also could help you out with. And again, the number. So sales or support at marketdelta.com, depending on your question. And then the phone number, 922-7800, to reach someone live. Either way, be able to contact someone and get your questions answered. Pete, how do I set? Pete, who asked me that question? That was Sam, about adding another market to the chart, right? All right, good. I'm going to send you the instructions to do that so you'll have it. Pete, how do you set the big size filter for the overnight session? Vince, what data provider are you using? And Pete, let me answer your question real quick. The same way that you would set it for this. This is the overnight session rolled into the day session, okay? But you would set it the same. So are you saying how to adjust it? Well, go into, do you have it set? Do you have the volume? Do you have the footprint at the bottom? So right click into the footprint, into that footprint, and this window should come up, okay? And then just change it right over here, volume filter, and change it overnight session would have lower volume that would be considered big, right? So maybe change it to 49 contracts. So you're looking for anything over 49 to pop up. So if I were to change this to 49, then I would see a lot more activity in here. And then, you know, it'd probably obviously more useful overnight. As I moved overnight in here, you could see it filter out, and even that might be too high because it's coming in and out and there's too much of it. You don't want to have, you know, you got the appropriate size, whatever market you're trying to filter, when you're not getting too much filled in, but you're getting something. It's that happy sweet spot medium. Did that answer your question, Peter? You're welcome. All right, guys, have a safe night. Make sure you get a hold of me or Market Delta to make sure you got any questions to get them answered, and go from there. Hopefully this has been helpful in kind of segueing you into new software. I know when I started trading with Market Delta 7 years ago, or using it and introduced, I'm a trader, so I'm not a technical guy, and being able to pull up everything and build charts, and so it would have been helpful to have some templates and to have some understanding of, I knew kind of how to use the footprint and what I wanted to use it for, but how to add the filter, take the filter down, put in red dots to show bigger volume, and throw up the footprint or throw up the volume profiles in 3 days, or 3 segments rather, today, yesterday, and the 5-day. I think it's always helpful to get context right there on one screen and things like that. So hopefully you guys found that helpful. You'll be invited to come next Tuesday and Wednesday. It'll be similar. It's going to be similar content. So more of a refresher. Don't expect something totally different. It'll be more of a refresher, but you should get the invitation to come for next week. But make sure you email with questions, because that's the only way anybody knows if you're having a problem, or the answers usually are pretty easy and pretty simple. It's getting the questions out. So have a safe night, guys, and either we'll see you in the trading room, or we'll see you next Tuesday, or we'll see you subscribe. Take care.